Hi. Most traders think the secret to becoming profitable is finding the perfect strategy, the perfect indicator, or a perfect entry. But the truth is, before you learn technical analysis, there are three things you need to understand first. A lot of traders learn these concepts after losing a lot of money. What's up everyone? Welcome back to a new video from Market Maker City. In this video, I'm going to explain these three concepts and show you why they are most important than most people think. Before we start, grab a notebook, a pen, and a coin. Okay? Flip the coin 10 times. Every time you get hit, imagine making $20. Every time you get tailed, imagine losing $10. Write down every result. For this example, we have 5 heads and 5 tails. The goal of these simple experiments is to show you something important. Even with equal odds, a bigger reward than risk can still make you profitable over time. If I had to divide trading into two parts, I would say around 80% is risk management, position management, and protecting your capital. The other 20% is technical analysis. So, technical analysis is important, but if you don't know how to manage risk, even the best analysis in the world won't save you. Let's start with stop loss. A stop loss is the price level where you accept that your idea was wrong and you exit the trade. The first rule is simple. Never open a trade without a stop loss, okay? Look, imagine you open a long position here because you believe the price is going to move higher. For example, if you buy an asset at $100 and decide that losing $5 is acceptable, your stop loss is placed at $95. If the price drops to $95, you cut the trade and get out before losing any more money. The stop loss is not there because you are expecting to lose. It's there because you are controlling your risk, okay? Your stop loss should not be too far and it should not be too close. If it's too far, the stop loss becomes pointless. If it's too close, normal market movement can hit your stop loss before the price moves in your expected direction. A good stop loss should be based on the market structure and your technical analysis, okay? For a long trade, your stop loss usually goes below a key support level. For a short trade, your stop loss usually goes above a key resistance level. As you can see, we've identified these two key levels and placed our stop loss where it's neither too close nor too far. Now let's talk about one of the most important concepts in trading, risk-to-reward ratio. Before we keep going, hit subscribe and let's build this trading community together. Thank you. Risk-to-reward ratio tells you how much you're risking compared to how much you expect to make. That means one winning trade can cover 2 losing trades and still leave you at break-even. My rule is simple. Avoid trades with a risk-reward ratio below 1 to 2. What's why? Because with a 1 to 2 ratio, you don't need to be right all the time. You only need to win about 35% of your trade to be profitable. But if your risk-to-reward ratio is only 1 to 1, you need to a much higher win rate. You need to win about half your trades just to break even, okay? So, the bigger your reward compared to your risk, the less often you need to be right. If you're following other traders besides me, unfollow them. Okay, I'm kidding. Don't do that. Okay. But seriously, whoever you subscribe to, make sure they cover this stuff. If someone gives you a trade with a 10% stop loss and only a 2% target, that's not a good setup. Okay, because 5 winning trades can be wiped out by just one stop loss, you know? Alright, now let's talk about risk management. Here is the big question. How much are you willing to lose on one trade? You need to know how much you can risk without getting emotional. You shouldn't get angry, panic, or revenge trade after a losing trade. That is one of the fastest ways to destroy an account. Personally, I usually don't risk more than 1% on a single trade. Even top traders often risk as little as 0.5% per trade because they're managing a ton of money, you know? Now let's combine everything. Imagine your account size is $1,000. Let's say your maximum risk per trade is 1%. So you set your stop loss at 1%. Your risk to reward can be 1-2 or 1-3. I personally prefer 1-3. You're risking $10 to make $30. In the long run, you'll still come out ahead. The M.M.C team has closed plenty of trades with 5-1 risk reward and even higher. So if you want to catch higher R2R setups like these two, follow our content. If your stop loss distance is small, you can use a large position size. If your stop loss distance is bigger, your position size should become smaller. This is called position sizing. Remember, it's important. Your stop loss distance decides how much capital you should put into the trade. I'll cover that in more detail later. The market always gives you another opportunity, okay? There is no point to take a trade with bad risk to reward ratio. If your setup is not good today, there will be another setups tomorrow, next week, or next month. The market is always there. Okay? The market is always there. If you are using leverage, risk management becomes even more important. For example, if you use 10x leverage and your position moves against you by 0.5%, with 10x leverage, a 0.5% loss turns into a 5% loss. This is why you always need to calculate your position size before entering a trade. I'll break down the formulas behind all this in a future video, so don't forget to subscribe. Remember these 3 rules. First, always use your stop loss. Second, never ignore risk to reward. Try to keep it at least 1-2. Third, protect your capital with proper risk management. Technical analysis helps you find better opportunities and improve your win rates. But risk management is what keeps you alive in the market. Trading is a long game. Your goal is not to win every trade. Your goal is to survive, learn, and become better over time. Thank you for watching. If you enjoyed this video, make sure to like it and save it for later. If you have any questions, leave a comments below. I read every single comment. Share this video with anyone who is learning trading and needs to understand these important concepts. Stay tuned. Good luck.